Welcome back to Zero Hedge Mentality. Today we're looking at a narrative that's, well, it's scaring the life out of the software sector right now. You've seen the headlines, the AI software apocalypse.
Yeah, it's the dominant fear right now.
And the logic seems sound on the surface, right?
Right.
Foundation models from OpenAI or Anthropic are going to commoditize code. They'll just automate the work.
Exactly. And if the work is automated, who needs to buy seats for human workers on platforms like Salesforce?
Right. The market is looking at Salesforce and treating it like a dying legacy incumbent.
They are. But we've spent the last few weeks tearing apart the data in the lab, and we think the market is looking at this completely backwards. Salesforce isn't a value trap. It's actually a classic contrarian value opportunity.
That is a pretty bold claim given the sentiment. So why is the market wrong here?
Because they're missing the agentic pivot. Everyone is panicking about AI replacing humans, which, yes, kills seat-based licensing. But our research shows Salesforce is successfully shifting the actual business model. They aren't just selling software tools to humans anymore.
They are starting to sell the digital labor itself through AgentForce.
Exactly. Selling the AI agent rather than the seat for the human. And if you look at the valuation we uncovered, the disconnect is staggering. Salesforce is trading near $189.
So you're looking at roughly 25 times earnings and, 14 times free cash flow?
Which for a cloud giant is absolute bargain basement territory. Historically, this company trades at 50 to 100 times earnings.
Right. The market is pricing it like the game is completely over.
But that discount exists because investors are ignoring what we call the metadata moat.
Let's break that down for you. Metadata moat. What does that actually mean in practice?
Think of it this way. AI models are like really powerful engines, but they're useless.
And dangerous.
And dangerous without fuel. That fuel is context-rich data. If you just plug an AI into a messy database, it hallucinates, it guesses.
And enterprise clients cannot afford hallucinations.
No. Salesforce's strategy, fortified by that $8 billion Informatica acquisition we analyzed, along with their MuleSoft integration, creates a data fortress. They control the metadata, which describes the data.
Meaning their AI agents don't guess. They act with actual context.
Right. That is a defensive moat the startup competitors just do not have.
Okay, but technology aside, how do they actually get paid? Like, if I'm a customer, am I still paying per user?
This is where our findings get really interesting. We dug into the new pricing models, and they're shifting to consumption-based flex credits.
So instead of just a monthly fee for a seat, they charge, say, $2 per conversation.
Or 10 cents per automated action?
That changes the math entirely.
It does. Our projections showed this could multiply monetization by 3 to 10 times per customer.
Yeah.
You aren't just selling a database. You are capturing the value of the actual work being done.
But we have to look at whether management is actually disciplined enough to pull this off. For years, Salesforce was the poster child for growth at all costs, spending like crazy.
That regime is completely over. We analyzed their capital allocation, and you can see the fingerprints of Starboard Value, the activist investor, all over this. They've forced massive discipline. We are seeing record margins of 35.5%.
And they're finally returning cash to shareholders.
Aggressively. We tracked a $50 billion buyback authorization and the start of a dividend. They are shrinking the share count.
I do have to play devil's advocate here, though. We track the insider signals, and they look conflicting. You've got Mark Benioff and Parker Harris selling stock. If the future is so bright, why are the founders dumping shares?
It's a valid concern, but you have to look at the type of selling. Benioff and Harris are selling on programmatic automatic plans. It's on autopilot. The signal we pay attention to is the smart money.
The activists.
Exactly. We saw massive buying from Mason Morpic at ValueAct. When an activist insider is buying up shares while the price is down, that is a signal of deep conviction in the turnaround.
Okay, so the valuation is low, the moat is real, and the activists are on board. But what breaks this thesis? What's the kill switch?
We identified a major structural risk in our research. We call it the seat compression paradox.
Sounds ominous.
It's a race against time, really. If AI solves 50% of customer service tickets, companies naturally need fewer human agents. That means fewer seats. The risk is that revenue from human seats drops faster than the revenue from AI consumption ramps up.
So there's a valley of death they have to cross.
Precisely. So we are watching specific signals to invalidate the thesis. If CRPO grows...
That's their committed backlog of future revenue.
Right. If that drops below 5%, we are out. Or if the DOJ blocks the Informatica deal, the moat crumbles.
Or if gross margins compress because running these AI models gets too expensive, the thesis breaks.
Exactly.
We're watching those signals closely, but for now,
The balance sheet is a fortress, and the cash flow is real. Our verdict is a high-conviction buy. It is a compounder on sale.
It really comes down to a simple question about market efficiency for you to think about. Is the market correctly pricing the death of SaaS? Or is it completely ignoring the massive optionality of autonomous enterprise agents? We think it's the latter.
The data suggests the crowd has panicked at the exact moment the technology is maturing.
That's it for this deep dive. Thanks for listening to the Zero Hedge Mentality channel. We'll see you in the next one.